Breaking news for Singapore investors. The country's three major banks have just released their first quarter results, and there's a clear message. They're battening down the hatches for potential economic turbulence ahead. UOB has taken the dramatic step of suspending its earnings guidance for 2025 due to uncertainties from U.S. tariffs, while DBS and OCBC are maintaining their forecasts, but with increased caution. All three local banks have reported relatively stable profits for the first quarter of 2025, but they're clearly preparing for rougher seas ahead. The most telling sign? They've all significantly increased their allowances, essentially setting aside more money as a buffer against potential future problems. DBS, our largest bank, posted a net profit of $2.9 billion, down just 2% from last year, mainly due to higher tax expenses from the new global minimum tax. Despite this small dip, they achieved record total income of $591 billion, up 6% year on year. They've also boosted their total allowances to $325 million. That's 56% higher than just last quarter. OCBC saw its net profit fall 5% to $1.88 billion, with the decline coming from lower net interest income and higher operating expenses. Meanwhile, UOB's net profit remained unchanged at $1.49 billion compared to last year. What's particularly interesting is how the banks are talking about the U.S. tariff situation. They're not so much worried about direct impacts. UOB says trade accounts for only about 10% of their portfolio, with 80% of that being intra-Asia. OCBC mentioned that only about 3% of their loan book is directly affected by current tariffs. Instead, they're concerned about what they call second-order impacts, the potential ripple effects throughout the economy. If consumer confidence drops and businesses pull back on spending, we could see a broader economic slowdown that would affect everyone in Singapore. For you as an investor, what does this mean? Should you be concerned about your bank stocks? Well, analysts have mixed views. Some have upgraded DBS to add from hold, with a target price of $47.90, citing sustainable returns. They've also noted that UOB is on track to meet its goals on total income and fee growth, despite pausing guidance. However, there are warnings about potential earnings downgrades for OCBC, which posted the sharpest net interest margin decline among the three banks in Q1. Its NIM fell to 2.04%, compared to UOB's 2% and DBS's 2.12%. The banks are still paying healthy dividends. DBS declared $0.75 per share in dividends, up from $0.54 a year ago. So while they're being cautious, they're still returning capital to shareholders.